Today, rates higher for longer, says the Bank of England. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news. Well, the Bank of England raised interest rates to a new 15-year high by 0.25%, warning that its fight against inflation may require tighter borrowing conditions for an extended period. And one thing that Andrew Bailey made very clear is that the bank will be data dependent in its future decisions. And one of their observations was that the MPC was split between those voting for no change, those voting for a 25 basis point rise, and those for a 50 point rise, indicating the uncertainty and complexity implied by the current environment.
Our job is to make absolutely sure that inflation falls all the way back to the 2% target and stays low. So today we've increased bank rate by 0.25 percentage points to 5.25%. Low and stable inflation is the foundation of a healthy economy. High inflation hurts the least well off the most. The projection that we present today is very much in two parts. I'm going to begin with the first part, which is the near-term outlook for inflation over the remainder of this year, before then turning to the second, which is the medium-term outlook and the implications for monetary policy. So starting with the near-term outlook. This chart shows the evolution of consumer price inflation and its components since 2018. It shows that inflation has come off the peak in October last year and that it continues to fall over the rest of this year in our near-term projection. That's the piece shown in the shaded part of the chart. Now, this fall can be attributed in large part to a falling contribution from energy. Fuel prices have declined and electricity and gas prices have stabilised, albeit at a higher level. The dark orange bars in this chart show how the contribution from energy prices is falling and turning negative, we think, in the coming months.
And there was a lot of discussion in the following press conference about the robustness of the models the Bank of England uses and their assumptions in the light of the recently announced Bernanke review. And traders saw the move as a dovish hike, and they cut bets on the peak in rates to around 5.75%. So the central bank lifted its key rate a quarter point to 5.25% on Thursday, which was in line with market expectations after a surprise half-point increase in June. But signs of debate between policymakers prompted traders to reduce those bets ahead to a peak rate of around 5.75%.
An increasing degree of economic slack is emerging after the middle of next year. This will help to reduce inflationary pressures in the UK economy. As Chart 5 illustrates, in the MPC's projection for consumer price inflation, which is conditioned on the market price for interest rates, inflation is more likely to end the forecast period below the 2% target than above it, albeit slightly. In the modal, or most likely case, inflation is 1.7% in 2 years' time and 1.5% in the third quarter of 2026. However, the committee continues to judge that risks around that central case are skewed towards higher inflation. Adjusting the modal projection for the balance of those risks, the mean or expected path for inflation is close to, albeit just below, the 2% target towards the end of the forecast period. Now, the projection for inflation is broadly similar on the alternative assumption of a constant level of bank rate at 5.25% throughout the forecast period, and that's discussed in the report. And this illustrates that different paths of bank rate can secure a return of inflation to the target.
The MPC left the door open for further action if inflation persisted and added language suggesting their stance would remain sufficiently restrictive for sufficiently long to bring it back to the 2% target. The bank reduced its growth forecast over the next 2 years and raised its outlook for inflation over the medium term. We have to balance the risk here, and we've got risk both ways, Governor Andrew Bailey told a news conference after the decision, adding that there were different paths to reach the target inflation rate of 2%, including by keeping rates unchanged over the medium term. There is no presumed path of interest rates. The Bank of England will have 2 more months of crucial inflation data before its next meeting in September. And asked when the bank would reverse course, Bailey said it was far too soon to speculate on when we might see a cut. Prime Minister Rishi Sunak has so far backed the Bank of England in its fight against price increases, even though the bank's forecast signalled a bleak backdrop for the next general election, which is expected to be held next year. The bank indicated the rate of inflation could fall by more than half this year to 4.9%, meeting a key pledge of Sunak's, but of course that's just pure maths, thanks to the base effect. The pound initially extended losses after the decision, and short-dated gilts gained as traders paired bets on further interest rate hikes. The currency paired its decline to trade 0.2% weaker at around $1.27 in London, and the yield on 2-year notes was about 7 basis points lower at 4.92%. The decision indicated a divide on the 9-member MPC panel about how the Bank of England should respond to indicators showing that wages and prices are rising too fast for comfort while activity in the economy is weakening. Catherine Mann and Jonathan Haskell voted for a half-point hike. Swati Dringi sought no change. The remaining 6, including Bailey and his deputies, were in the majority and noted that their action would weigh heavily on households and businesses. The vote split indicated we are nearing the peak now, said Luke Hinkmore, an investment director at Aberdeen. Some of the language used today also suggests that they're getting nervous about the economy's reaction to the hikes in place so far. The Bank of England's decision to step down the pace of tightening in August suggests it is a little less troubled by the inflation outlook than it was in June. That said, the messaging around the decision suggests there is a little further to go in the tightening cycle before the central bank will feel comfortable pausing. The Bank of England maintained its guidance that if there were to be evidence of more persistent pressures, then further tightening in monetary policy would be required, according to the minutes. And it's added a sentence suggesting that once the tightening cycle was finished, rates may remain elevated for some time. The MPC would ensure the bank rate was sufficiently restrictive for sufficiently long to return inflation to the 2% target sustainably in the medium term, in line with its remit, it said. And key indicators, especially wages growth, suggest that some of the risks from more persistent inflationary pressures may have begun to crystallise, they added. Economists were divided before the decision about how aggressive the Bank of England would be. Of the 61 economists surveyed ahead of the meeting, 45 expected a quarter-point rise in bank rate, and the rest predicted a half-point increase. Investors read the decision as an indication that borrowing costs will peak sooner as inflation cools, and a little under a month ago, traders had priced in terminal rates in excess of 6.5%, with some economists warning that 7% was a possibility. The Bank of England confirmed that it would decide next month on the pace of its effort to run down its balance sheet of bonds that were built up during a decade of quantitative easing. The second year of so-called quantitative tightening will begin in October. And the central bank's forecast indicated the UK economy will avoid a recession ahead of a general election. However, the charts indicate the range of possible scenarios, and they show that there is still a significant risk of a contraction. Britain's economy will likely stagnate through to 2025, according to their forecasts. It expects gross domestic product to grow 0.5% in both 2023 and 2024, and by 0.25% in 2025. By the end of the forecast period in 2026, GDP will be 0.75% lower than estimated in May. And the committee agreed that slack in the economy was likely to emerge as the quickest cycle of rate hikes in 3 decades cut into the money consumers and businesses have to spend. Unemployment is likely to increase to about 5% by the third quarter of 2026 from 4% currently. And vacancies have already started weakening. While the UK's rate of inflation fell to 7.9% in June, it's still the highest among the group of 7 nations, and price pressures in the services sector also cooled for the first time in 6 months, although the Bank of England said they are expected to remain around their current elevated levels. If we stick to the plan, the bank's forecast inflation will be below 3% in a year's time without the economy falling into recession, Chancellor of the Exchequer Jeremy Hunt said in a statement. But that doesn't mean it's easy for families facing high mortgage bills, so we're going to continue to do what we can to help households. The latest increase in bank rates will hit the finances of households with variable rate mortgages immediately, but lenders are starting to cut the costs of fixed rate deals on an improved outlook on inflation. A quarter-point hike means that average monthly payments for households on variable mortgage rates have increased by £489 since the Bank of England started raising rates in December. There is a risk of over-tightening, Martin Wheel, Professor of Economics at King's College London, said, but hindsight's a wonderful thing, and if there is a recession and inflation does come down quickly, then people will say the bank over-tightened. But the key takeout here, and it's one that I keep coming back to, is this thought of higher rates for longer. So those who are expecting a significant turn and cuts in rates anytime soon, I think are going to be disappointed. It's a similar mantra that we heard from the US and also from the Eurozone as well. But all of this seems to me to put the Australian situation and the RBA out of kilter substantially. And I wonder whether that's because they're more concerned about the crash that could be coming into the housing sector if rates were to go higher. Well, I guess we'll see down the track. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.